Hi, I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, August 15th. To view our full range of publications and trading services, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. The equity markets have been on a winning streak and just crossed a crucial technical threshold. Technical traders cheered the S&P 500's close of 4,280.15 last Friday. That's because a close above 4,231 meant the benchmark had recovered or retraced 50% of its decline from a January 3 record finish at 4,796.56. History tells us why Friday's closing number is an important threshold. Since 1950, there has never been a bear market rally that surpassed the 50% retracement and then gone on to make new cycle lows. Don't get me wrong, the bear market isn't dead yet. We're still officially in bear territory. A bear market ends when the index reaches its low before going on to set a new high. But perhaps that faint sound you hear off in the distance is the death knell for the bear. The lows are starting to get higher and the highs are starting to get higher. Stocks certainly had a good week. Take a look at the following table. Gains for the week of August 8 through 12 were as follows. The Dow plus 2.9%, the S&P 500 plus 3.3%, the Nasdaq plus 3.1%, and the EAFE plus 2.4%. A bevy of positive data on jobs growth, inflation, and consumer sentiment buoyed Wall Street and suggested that the Federal Reserve might soon get less hawkish. As of market close Friday, August 12th, the S&P 500 was 16% higher than its low point in June. Crude oil prices rose for the week with a gain of 3.2%, but take a look at this chart. Over the past month, oil has fallen as traders predict that slowing economic growth will weigh on energy demand. The oil price rally has lost steam this summer, with oil falling below $100 per barrel. Also pushing down the price of oil have been unexpectedly high inventory builds. As this chart shows, commodity and energy prices have been falling, which has generated better news on inflation, which in turn has driven the stock market higher. Over the long haul, commodity prices will probably resume their upward trajectory and remain elevated due to rapid development in emerging markets and the electrification of global economies. But right now, we're getting much needed short-term relief. The falling price of oil has been great news for consumers who are feeling less pain at the pump. As you can see from this chart, the retail price of gasoline in the United States has plummeted, helping quell inflation. I've noticed that the press has given less attention to gas prices now that they're falling as compared to the hysterical coverage given to gas prices when they were rising. As an investor, always be aware of the media's negative bias. Let's now turn our attention to Washington. In addition to the CHIPS Act, which seeks to boost the U.S. semiconductor industry, we also saw passage of the Inflation Reduction Act. The bill is smaller in scale than the proposed 2021 Human Infrastructure Bill, but it's a miracle that anything got passed in the toxic halls of Congress. The Inflation Reduction Act makes a down payment on deficit reduction to fight inflation, invests in domestic energy production and manufacturing, and encourages deployment of green energy, notably electric vehicles, to reduce carbon emissions by roughly 40% by 2030. The bill also allows Medicare to negotiate for prescription drug prices and extends the expanded Affordable Care Program for 3 years through 2025. The bill also closes loopholes used by the wealthy by imposing a 15% corporate minimum tax, a 1% fee on stock buybacks, and enhanced IRS enforcement. In provisions heartily endorsed by the automobile manufacturing industry, the bill implements clean energy tax credits, including those to encourage electric vehicle purchases and the use of green sources of electricity and energy storage. The bill offers consumers a tax credit of $7,500 for new EVs and $4,000 for used EVs to make these vehicles more affordable. This week, we'll get a new round of crucial economic data. On Monday and Tuesday, keep your eye on reports related to housing, which is a bellwether sector. Weakness in housing is often interpreted as a leading indicator of economic woes to come. On Wednesday, the main events will be retail sales and release of the Fed's minutes. Stocks would probably surge if retail sales come in strong or if it's revealed that at their last meeting, Fed officials suggested that a pivot is on the way. The next big data release will be on Thursday, with initial jobless claims and existing home sales. The betting on Wall Street is that we'll get yet another strong reading from the jobs market. I expect equity markets to continue rising in the coming months, but it won't be in a straight line. We'll continue to see volatility. And don't forget, the November midterm elections are fast approaching. The political squabbling could get so ugly and outrageous it roils markets. I continue to recommend an emphasis on value and defensive plays, but now is probably a good time to dip your toes in the water with the growth stocks that have been on your shopping list, but which were too expensive. When it comes to growth stocks, you should position your portfolio for the next big thing in technological disruption: flying cars. The depictions of flying cars in science fiction go back decades, but flying cars aren't fiction anymore. They're ready to hit the skies and change daily life as we know it. Major aviation firms are lining up behind one company whose groundbreaking flying car technology could be just weeks away from being unleashed on the world, and which stands to dominate a burgeoning $9 trillion market. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for today. Thanks for watching. Stay invested and stay safe.